I think it's been very interesting last 6 to 8 weeks as the trade tensions have unfolded. I think certainly the perception is that the Trump administration is not keen to look for a multilateral solution. It's been far more tactical in terms of its approach to the trade tensions. So I think it's great to see the two parties coming back to the table again. Certainly all parties are looking for a resolution. But perhaps we'll see an easy solution around some of the tariffs perhaps being lowered on both sides if a multilateral approach is not going to work. I think the more challenging one is what happens around intellectual property and IP, because I think that's not a 6-month solution. I think that's something which is going to tail out, and perhaps leading up to the Midwest elections, if the Trump administration looks to perhaps look at some tariff reductions on their side, together with some margin compression from the China side, given that the China tariffs have certainly been very high historically, then maybe we'll seek some middle ground and we'll get a positive resolution.
I guess one of the other factors talked about a lot here is that the US economy is strong and therefore can take a little bit of this trade pressure in the short term. What's your view on the China economy at the moment? Can we believe the 6.7%? And if this really escalates significantly, who do you think of the two economies can hold out for longer?
Well, I think the Chinese economy has been incredibly resilient. I mean, how many economies globally have been growing at the kind of growth rates that we've seen over the last multiple years? And those growth rates, we expect to continue. I think just China and Asia in general overall, when you think about China representing 31% of global growth, if you think of non-Japan Asia, it's also about 60% of global growth is substantial. So whilst at the moment there's some pressure around deleveraging, and the Chinese government are obviously taking steps around that, it's interesting to see that the currency has gradually depreciated. Certainly we're not too far off where we were at the beginning of the year, and I think that will remain trade-bound, but it does have a massive arsenal to be able to utilise in terms of reducing the reserve requirement ratio further, extending the medium-term lending facility, in addition to the arsenal it has in terms of its dollar reserves.
Yeah, I mean, we've seen them sort of ramping up their efforts, stimulus, monetary, fiscal. Did they put a floor under the stock market and the falling currency?
Well, I think in terms of the currency, what we've seen certainly from an Asia perspective, and in fact more recently over the last sort of 1 to 2 months, and it has been that time frame, is that there are views that the currency is actually looking relatively cheap sort of versus its sort of peers. So specifically when we look at the domestic Chinese fixed income market, we've seen yields there collapse from a wide versus the 10-year treasury of 110 basis points in Q1 to around 30 to 40 basis points now. I think the government is also being incredibly careful to ensure that the currency is not being seen as a medium to be able to retaliate against the trade wars, and is taking steps to be able to adjust that. I mean, one example would be in terms of how it's approaching the household account flows. Historically, China has allowed $50,000 per household to be able to buy dollars, and I think they've become far more prudent in terms of how they approach that, because if you have 20 million people that want to take $50,000 out, you just have to do the math to understand how much dollars could be leaving the country.